Thank you for the invitation to speak here today. My remarks will fall in two parts. First, I will focus on negative interest rates and their potential side effects. And subsequently, I'll talk about how the ongoing process of digitalization may affect central banks and the future of money. And I will look at the Danish experience. This is a bit complicated chart, but the dark shaded areas are periods with significant currency inflows, and the lighter shaded areas are periods with outflows. In Denmark, we have had negative interest rates for quite a while now in order to keep the Danish crown from appreciating against the euro. We have a fixed exchange rate policy against the euro. But as you can see from the blue line, negative rates of interest, central bank money market rates have been negative for almost 4 years. And so we have some experience now on how is negative interest rates affecting the monetary system in Denmark. Our key monetary policy rate became negative for the first time in 2012, and it has stayed below zero since, with the exception of a few months in 2014. And you can also see the turmoil with the Swiss franc in early January 2015, which led us to reduce interest rates quite dramatically down to minus 75 basis points. We have raised them a bit, but they're still at minus 65. What is our experience with negative interest rates? Well, it's quite reassuring in the sense that in our experience, negative interest rates works broadly in the same way as very low but positive rates. In particular, the transmission to money market rates and to the exchange rate has been as expected. This one. In a recent paper, we have studied the impact on loan and deposit rates for corporations and households. We find that the changes in the policy rate have been fully met by changes in the lending rates for both corporations and households. But pass-through to deposit rates has been more limited. Prior to the financial crisis, there was a full pass-through to deposit rates as well. The reduced pass-through from monetary policy interest rates to deposit rates reflect that banks have been reluctant to charge negative deposit rates for certain groups of customers. In particular, no households have been faced with negative interest rates on their deposits. It may also reflect that we have a tiered system of bank deposits at the central bank. This means that only the marginal deposits with the central bank meet the negative interest rate. But on the other hand, roughly 30% of deposits from non-financial corporations receive negative interest rates. Negative interest rates are particularly widespread for institutional investors such as insurance companies, pension funds, for which the alternative to a bank deposit is to place funds on terms reflecting those in the money market. This could be in short-term bonds where interest rates are also negative. Actually, at this juncture, the Danish yield curve is negative up to, I think, around 6-7 years for government bonds. One of the potential risks associated with negative interest rate is that of cash hoarding. In Denmark, we have not observed an extraordinary withdrawal of cash. One explanation is that banks have been reluctant to pass on negative interest rates to households. Cash holdings by households are almost 75% of total non-monetary financial institutions' cash holdings. So in order to observe cash hoarding, we need to see a large increase in cash holdings from corporations. For monetary financial institutions, it's not realistic to convert reserves to cash because of the large costs associated of storing and making transactions with cash. So here we have the circulation of our large notes, and you can see they are basically on trend whether an investor decides or not to hoard cash due to negative interest rates, the expected profit from doing so is a function of the daily payoff, but also for how many days a profit can be expected. Hence, the time dimension has to be taken into consideration when considering the risk of cash hoarding. Our experience has been that minus 75 basis points was not the lower bound. I've tried to illustrate it, the returns from cash hoarding with the area here that reflects the level of interest rates as well as for how long time you expect negative interest rates to remain. And as can be seen from the right-hand side, the profit from starting to build the facilities needed to hoard cash will depend very much on the timing. Compared to February 2015, the incentive to switch to cash is currently about the same level. This highlights that a business case of building vaults and store cash is a very uncertain business. I also think it's, I think investors who are considering hoarding cash, they should also think very careful about that central banks could also come up with bright ideas. I mean, in principle, the Danish central bank is not obliged to supply whatever cash that is demanded. We are obliged to supply whatever amount of cash is needed. So should this become an issue, I think we would have to think carefully how we would solve that. The low interest rates is affecting banks, but their challenges have so far been manageable. In line with this, it's worth mentioning that in 2015, total profits in the Danish banking sector were on the same level as before the financial crisis, despite the introduction of negative interest rates. A part of the explanation is the current low loan impairment charges. They are to be seen in line with the low interest rates as they stimulate the economic activity and also increases lenders' disposable income and thereby making it easier for them to service their debt. Having said that, it should be noticed that the low interest rate is squeezing the bank's net interest income, as reflected here in the blue area in the chart. Despite the banks having passed on negative interest rates to institutional investors and large companies. However, the banks are adapting to the situation and they have increased earnings from fees and administrative margins on mortgage loans, as been reflected in the purple and the red area. This is a structural change which implies that the customers to a higher degree pay for what they get instead of paying indirectly through interest rate differentials. It can increase the transparency depending on how complex the fee structure is. Let me now turn to the second topic of my introductory remarks for today, the ongoing digitalization and its effect on the business of central banks and banks. I will concentrate here on the implications for central banks' tasks concerning payment systems. Central banks may wear many hats with respect to payments, as providers of large value payment systems, as overseers, as regulators. Lately, however, two other roles have been more in focus. The first is the function as facilitator or catalyst of payment systems developments. The second is the role as issuer of legal tender. With reference to the role as catalyst, several central banks have recently put pressure on the industry to deliver instant payments. A revolutionary thought among many banks, but definitely not among the digital natives, the generations unfamiliar with the life before smartphones and the internet, who are used to communicating without delay. Preparing a payment system for instant payments is like modernizing the rail network to promote faster trains. The advantage of a 200 miles per hour train can only be realized if the rails are new and straight, not if they are old and full of curves. Similarly, new payment methods like mobile payments shine the most when funds are transferred immediately. Taking this analogy a step further, one aspect of rail construction might differ, though from that of improving a payment system. Often the travel time by train is shortened by skipping stops at smaller towns. In the case of payment systems, however, an important objective is reachability, to be able to move funds between each bank account at all relevant banks. Denmark is a case in point of what I'm speaking about here. Here, instant payments were introduced for amounts up to 500,000 Danish crowns, that is approximately 75,000 US dollars, in 2014 as part of a major overhaul of the domestic payment infrastructure. And during the initial discussions of a working group of banks, they were quite hesitant and pointed to the lack of a business case. Today, however, there seems to be a genuine satisfaction with the new service, which turned out to be instrumental for an unparalleled fast takeoff of two mobile payment solutions launched by Danish banks. One is called Mobile Pay, another is called SWIP. But as you can see, the Mobile Pay system, more than 50% of the Danish population now are users of one commercial bank system, even though they're not customer with that bank. So actually Mobile Pay became the word of the year in the Danish society a 2 years ago. So the adaptation into society of faster payment systems is really, really fast. I think the Danish experience illustrates the usefulness of a central bank playing its catalyst role with respect to payment systems development. This should be properly dosed, of course, but I doubt that much would have happened without a certain element of moral suasion. In my opinion, it also exemplifies the kind of issues where central bank involvement is justified. If the incentives among the owners of the payment infrastructure make them stick to the status quo, and if this is not seen as a socially optimal in the longer run. Digitalization has also put spotlight on central banks' role as provider of notes and coins, as cash is coming under pressure from different angles. This includes a decrease in demand for cash for transactional purposes in many countries, as well as the recent mushrooming in numbers of alternatives to cash in the form of virtual currencies. As a result, a debate has revolved whether central banks should start to issue some sort of an electronic version of cash, be it e-money stored on a plastic card or held at an account or on a server or on a digital ledger technology, distributed ledger technology-based electronic currency. Some central banks are analyzing this and considering their options. However, here I might be less convinced that central banks should take an active role in providing e-money to the general public. In fact, it seems difficult to see the value added of such an initiative compared to privately issued e-money or even payment solutions based on commercial bank money. At least I should not be motivated by a desire to protect the value of seigniorage. And let me conclude with an issue with perhaps far more far-reaching consequences, including for monetary policy, is how the digitalization will affect central banks' role as the main settlement bank for commercial banks. In the future, will one or more large banks succeed in offering similar services by leveraging on, for instance, the DLT technology, and how should central banks react to this? I don't have the answers, but I think that those are the questions we need to think about in depth. Thank you very much.
Thank you very much.